All right, welcome to the Regions Investment Committee meeting. And the first item of business will be the approval of the minutes of the meeting of January 21st, 2020. I believe we need a roll call vote
Yes,
on that.
yes, we do, and that can also serve as, I'll do roll call and attendance and minutes at the same time. So committee members, Anguiano, Blum,
Aye.
Cohen,
Aye.
Elliott, Lieb, Makarisian,
Aye.
Napolitano,
Aye.
Newsom, Park, Perez, Sherman,
All right, here.
Aye.
and Zettel. You have a quorum and the minutes are approved.
All right, our first item, only item, I1 is a discussion. We're going to have an update on the University of California investment products, including the retirement, endowment, and working capital. So I will turn it over to Jagdeep.
Thank you, Regent Sherman.
Thank you.
All right. I want to start it out the presentation by talking about the UC Investments Way. And this is an interesting time we're living in because all of my team are working out of the house and we're managing assets for the University of California. And there has to be a culture before we got into this situation that helps glue and bind all of us together. So we created these 10 pillars, what we've been calling the UC Investments Way, to guide our long-term investment strategy. Over the past 6 years, that's the time since I've been the CIO, these guideposts have become something much bigger for us. They've endured because they work and they underpin whatever we do. In fact, one testament to the 10 pillars is that the endowment's performance 6 years ago, as of March 31st, in fact, even 10 years ago, was in the bottom quartile of all US colleges and universities. And as of this last year, on June 30th of 2019, we're in the top decile. And we've done that by focusing on these principles that bind us together. And these are the values. And what I have found in the last 2.5 months is more than even the 6 years I've been in the office physically. Having these guiding principles helps us with making our decisions. So what are these 10 pillars that have guided us? And this is exactly what we are doing on a day-to-day basis as you see us all operating out of the house. So first of all, less is more. Secondly, an intense focus on risk rules and risk management, even before we think of ourselves as asset managers. Concentrating, thirdly. Being creative where we can, build our knowledge, teaming up internally and externally with the university system. More so than ever, these last 2 months have shown that what makes the UC is why we're such a great institution, but also has been our competitive advantage and will be a competitive advantage as we think about healthcare going forward. Aligning ourselves as perfectly as we can. I used to see these words of human meets machine for the last 6 years and wondered when exactly was technology going to be the driving force behind our investments. And I think in the foreseeable future, what we've also seen in the last couple of months is technology has been a key driver of what has worked well, but will continue to be a driver of success in investments. And keeping focused on the long term. In the short term, things go up, things go down. But what's most important is how do they perform over the long term, because that's what we are, a long-term institution. So as of May 18th, which is yesterday, the assets under management at the University of California total $125 billion. Now, over the past 6 years, we've seen our assets grow by 27 billion. So that's about 29%, from 92 billion to 119 billion. And that 119 billion was as of March 31st of 2020. So let me show you this simple graph because by the way, in April of 2020, the last month, our assets grew by 7 billion from 119 to 126 billion. But let's just take a picture of this fiscal year. On July 1 of 2019, we started with 126 billion. We grew by $1 billion in the first quarter from July through September. And then fueled by very strong growth in the public equity markets, our assets grew in the second quarter from September through December to $133 billion by the end of the year. The third quarter of the fiscal year brought unprecedented risks in the markets, as we all know from a global pandemic that started in November of 2019 back in China. Now, global public equity markets fell 34% from their peak on February 19th of 2020. And that trough was seen on the 23rd of March of 2020. And so we ended the quarter with 119 billion. And that quarter, that it represents on a mark-to-market basis, a drop of 14 billion, which is 10.5% from January 1. Markets have since rebounded, thanks to governments around the world providing close to almost $10 trillion of fiscal stimulus. And of course, the closest parallels to what we are seeing goes as far back as the global Great Depression. But the levels of stimulus we've also seen are without historical precedent. And as a result of these actions taking effect in the markets, and of course, a degree of optimism that is quite spectacular by any standards, we've seen our assets rise from 119 billion to 126 billion at the end of April. Fast forward to yesterday, our assets were $125 billion. So a lot has happened very quickly. Yet when you look at this chart, it looks like where we started at the start of the fiscal year is where we are at the end of the fiscal year, approximately. Now the question is, that's for all the pool of assets we manage. How did that translate into the performance for the pension and the endowment and the other pools of capital we manage? Now, I have sent you a summary of the performance for March 31st time periods looking back. And you've got the details around each of the products we manage as well. What I wanted to do today was simply focus on how things have been through May 18, if we use that most current lens for performance data. So let's start out with long-term performance. And really the key driver, whilst there are many things we can talk about at an asset class level, the key driver has been the stock market, both as I've just described in the short term, driven by the global pandemic, but certainly also in the last 12 years, looking back to the times when we had the global financial crisis. A very robust stock market and sharp declines have contributed to the performance I'm just about to show you. So when we talk long-term, I want us to take us back to 25 years. And if we look at the pension on an annualized basis, the pension has done 7.7% for 25 years annually. 10 years is also 7.7 coincidentally. Keep in mind the discount rate or the expected return, if that's the proxy for the discount rate, is currently 6.75%. And the reason we moved it lower is in the last decade or the current environment, it is hard to earn a return. And as you can see in the last 5 years, the returns for the pension have been about 4.5%. Now, why is that? Over these last 25 years, interest rates have dropped to almost zero. And frankly, in the foreseeable future, with all the fiscal stimulus, particularly here in the United States, we could see an environment where interest rates remain zero for an extended period of time. So let's turn our attention to the short term as of May 18th. And I want to focus on 3 time periods here. The calendar year to date, which is from January 1 through yesterday. The fiscal year, the 9 months going back to July 1 of 2019, or 11 months. And then the 1 year returns May to May. As you can see, we were down 7.5% for the calendar year. The fiscal year down 2.1%, and on a 1 year basis, we are actually up 2%. Now let's turn to the endowment, and let's do the same thing. The endowment is 13.7 billion in assets. Over the long term, 25 years, their endowment has returned 8.4%, about the same over a 10-year period. In the nearer term, in 5 years, it returned 5.6% on an annualized basis. Keep in mind in the endowment, we aim to achieve 8% or better if we can, because that's where the spending That's the expected return with a starting point of a 4.75% spending rate for the endowment. Let's look at what happened in the shorter term with May 18th yesterday as a marker. For the calendar year, we're down 5.3%. On a fiscal year basis, we're roughly flat at 0.2%. And on a one-year basis in the endowment, we're actually up 4.1%. So whilst a lot has happened in the last 3 months and 5 months, particularly in the markets, both down and up, on a one-year basis, the numbers still look such that it doesn't feel like a lot has happened when we look back. Now, whilst those are the absolute performance numbers, what we focus on as a team is how can we add value on a day-to-day basis in these portfolios through active management. And to put it in context for you, when I joined 6 years ago, we had about $15 billion of our assets indexed. Regent Sherman and I and others on the committee have been a believer that if it's hard to beat the markets, we should at least be in the markets in a passive indexed format. And so today we have close to 60 billion in the index, or a variety of indices in stocks and bonds. And we have about 65 billion actively managed. I can actually see our indexed investments growing by another $15 billion or so over the course of this calendar year. But by actively managing our assets, we've generated $5 billion of value added over the 6-year time period, in addition to what we would have earned simply by being in a passive index. 3 billion of that is for the pension, 1.4 in the endowment. But as you all recall, over these last 6 years, as we've seen these numbers, we really talked about two things. Every time we've got together, we've talked about rising stock markets, particularly in the US. And we've talked about growing global risks, particularly populism and US-China relations. And as we get closer, and as we actually got closer to this longest economic recovery we'd seen going back almost 100 years, we wondered what risk, whether it was a known risk or an unknown risk, could challenge such growth. And then we saw the unknown global pandemic risk lead to the fastest drop of 34% since the Great Depression. And frankly, also the fastest rebound of 20% in a month. Now, our way of living has clearly changed, as demonstrable by how we're meeting today here in 2020. But questions still remain about how long it might take us to emerge into this new normal. We've also never seen the global economy shut down the way it has been. So we certainly don't know how the experiment's going to play out going forward. So whether you're an individual or you're a company or you're a university, financial sustainability and survivability will be determined by liquidity. Regent Sherman and Regent Makarishan and others have repeatedly said to me over the years, cash is king. Interestingly enough, many a times in the last few years, we were getting paid to hold cash with what we were earning on treasuries, as an example, or even in our short-term investment pool. So coming into the global pandemic, we had about $15.6 billion of liquidity across our various products and pools as a way of being defensive coming into this market environment, not knowing when it would happen. That number stands today at a higher amount, and we've continued to raise liquidity as we've felt more comfortable in taking chips off the table from these markets that seem, in my opinion, higher than a level that is warranted based on the economic reality that we're all facing today. In April, we found ways to work with our campuses to provide them liquidity as they were planning for this future. And today, what we're most concerned about and also best prepared to do is position in a way that we can do a couple of things. First of all, make sure that we have, in our case, $8 billion. That's 100% of our unfunded commitments to our companies. So we're good for the capital that we've committed to them historically. We also have liquidity to meet our obligations for the pension and the working capital payouts, the endowment and the working capital payouts at about $750 million combined. We are holding between the pension and the endowment which are restricted funds in those two pools of capital solely available to invest for the pension and the endowment, funds close to $20 billion to put back into the markets when we see attractive opportunities. But most importantly, what makes the UC means whilst we are managing our investments, our most important priority is making sure that the university has a future that is financially sustainable. And to do that with a strong liquidity position in order to enable how we manage the future, we want to continue to be partners with the regents and the administration to help work through this crisis. Regent Chairman, that concludes my remarks. I'm happy to take any questions from the committee.
Sure. Before we go to some questions, I have just a couple to throw out here. When you talk about the flow of the total assets under management from period to period, do you have an idea, at least on the endowment side, what kind of net inflow or outflow has been the kind of the net cash flow, independent of performance, over the periods that we've mentioned here?
So looking at 6 years,
Right.
since I've been the CIO, we've seen $3.5 billion of inflows.
All right. And so basically the rest is performance.
That's right.
Yeah.
And so the 3.5 billion, the value added is 1.4 billion, and the rest of it would be the growth if we were just in an index managing.
Got it. And then maybe you can give us an update on where we stand on our exposure in the fossil fuel asset class, given what's on in the energy markets.
September 19th of last year at the Regents meeting, we announced that the endowment was fossil free and that the journey we've began 5 years ago around incorporating environmental, social, and governance risks into our investment decision-making included a focus for us around the financial risks from holding fossil fuels in our portfolio. When we announced in September that the endowment was fossil-free, we said at the same time we would continue our focus on the pension. And I'm happy to announce that actually as of today, the endowment, the pension, and all of our working capital pools are fossil-free at the University of California. In fact, you could extend that to say that our $125 billion of assets are fossil-free.
Good. All right. I see we've got a couple questions. First, we'll go to Regent Mark Reason.
Thank you, Jagdeep. Thank you, Chair. Jagdeep, a couple of questions. I think 119 billion or 120 billion or 130 billion or 80 billion, really, those are just numbers. But what percentage of funding are we for retirements at this point in time?
So the funding ratio is, with the current market values, at about 74 billion. 74%. Yeah. And when we were at the peak or the last fiscal year, we would have been close to 81%.
And that's based on our stated discount rate of 6.75%?
That's correct.
Okay. So at this point in time, based on your 5-year returns, I saw it in the other materials that you had provided us. When you look at the 5-year return and when you look at the 10-year and all that stuff, and I understand that the lower that discount rate, the better it is for you because you don't have to perform. So it's basically,
well, we still have to perform, but yeah.
I mean, the lower we bring the discount rate, if we put the discount rate at 10%, then you have to return 10%, right? Otherwise, you won't be performing. But at the same time, if you lower it, then the funding ratio will come down, and both the employees and employer will have to come out of pocket and add something to the pot. Otherwise, we won't be able to pay our retirees. So at this point in time, based on the past 5 years and also what we look forward to the next 2 or 3 years, unless you take all your $20 billion that you have accumulated in cash, which I think at this point in time, cash is king, but this is the time to use the king and, move the queens and the other stuff on the board off and make some money. If we don't invest and we don't get a huge return, then I think we may have to lower that discount rate. What is your opinion?
So to the asset allocation of the pension plan is 50% stocks, 20% bonds, and 30% private assets, long-term targets. Today we are 40% stocks, 20+% bonds, and we have about 21% in private assets, and we've got the balance in cash.
Well, you're in the range of or allocation.
We're in the range. We're in the range. We're in the lower end of the range in the riskier assets, and we're in the higher end of the range of the more conservative assets. But to your point, with interest rates and all the stimulus suggesting returns from fixed income close to zero, if not zero for the foreseeable future, that means all your conservative assets, whether it's cash or bonds, are basically going to earn you zero.
Yeah.
So the more of that you have, the less you're going to be able to earn. And if that's 30% of how we're invested right now, you're absolutely right. There's no way you can achieve that discount rate. Now, in addition to that, the other variable is how will stocks do? Over the long term, we've clearly seen that stocks are a good place to be invested in. We just don't know what's going to happen in the short term with the stock market. So the only reason for me to be more defensive now is just to have the capital available to invest at attractive prices when the markets drop. But frankly, the environment to earn returns, we've been saying this for 5 years, that it's a low return environment. I think they just got lower unless you see another bull run in the stock market like we did in the global financial crisis over that 12-year period, which I don't know when that starts or when it begins to happen. I anticipate over 20 years that'll be the case, looking back. So that's the investment side of the equation. Clearly, the other side of the equation is the contributions, because those two things have to balance to try and maintain a funding ratio. And if we're trying to maintain a funding ratio at least 70% or above, one part or some parts of these equation have to add to make up that contribution, that funding ratio.
But I mean, think about it. The contribution side is not going to happen because university doesn't have funding. The state is not going to contribute at this point in time with this environment that we are in. And at the same time, we are asking some probably perhaps down the road, like the president suggested, 10% reduction in her own salary, as well as the chancellors and so on and so forth. So everybody's under stress anyway. So the contribution coming from the state or from the employer and employees is going to be, I think, is going to have a very small chance of happening. That's one side of it. On the other side, for the stock market to go up, you need to have continued this flooding of funding by the federal government or by the Federal Reserve in order to create inflation and the stock go up. So to me, holding $20 billion plus, holding those secure assets that are not returning anything, zero, for you, that's a huge percentage of your holding. So which pushes you to have to make twice, I don't know if that's 40% of the total assets, then that means the other 60% will have to perform twice as much to average down to the rate of return that you're looking for. How are you going to achieve that?
Yeah, so absolutely. Think of this as a tactical positioning versus a strategic posture for the long term. I mean, the other option I have is I could leave all of that $20 billion in the stock market, and then we'll just ride it out as the markets go up and down from here. I think the risk profile is asymmetric at this point. There could be some upside, like on days like yesterday, but there could also be potentially more downside in the short term. So what I really am more enthusiastic about is private market opportunities and potentially levels when the stock market gets to attractive prices where we could potentially put more into the markets. But even in terms of private assets, real estate, for instance, once viewed as a defensive asset class, may have some structural thinking around what happens with real estate. Real assets could be attractive, and they have actually played out well for us. And that's another place where we could potentially find opportunities to put in. Private equity, interesting place, but at the same time, there is a lot of capital, probably $1 trillion of the same kind of, cash available in the marketplace to put into companies. And we still haven't seen sort of what's the extent of the economic pain yet. I mean, frankly, the phone is not ringing off the hook at this point with opportunities for me to put money to work in. And when I do get those calls, I still feel that they're priced for a world that we were in versus the world that we appear to be living in right now. So in the short term, and this is absolutely a tactical positioning, not a strategic posture to achieve our long-term targets, but I would much rather be prepared to take advantage of opportunities when they arise and have the capital to put to work versus having to then liquidate things that might be unattractively priced to then find capital to put to work in the markets.
Well, that's exactly what I'm saying is, for instance, when the shares went down 34%, we had a lot of liquidity, right? And at that point in time, the market went down to about 18,000 something. I mean, I think, at times you have to take advantage of those situations and jump in. And I'm worried that with the cash that you have between pension and endowment, which is about $20 billion, and then you take the cash that you're holding for the campuses, the TRIP and STIP and all that stuff. I'm thinking that you maybe, when you average down your returns, we may be very short down the road if you don't take this tactical stuff. I mean, again, you have a 2-year play, in my opinion, just one person's opinion. You have a 2-year play, and then you have a 10-year play, and then you have a 20, 25-year play. Yeah. And I'm concerned that within the 2-year play, we may not be positioning ourselves to make a ton of money.
So, Regent Sherman, Regent Migration, I mean, I can't predict what making a ton of money is going to look like right now. We all want to make a ton of money, but there's also a ton of risks. And I think, having said that, let me paint a picture for you in March. Historically, a pension plan has fixed income in bonds so that when you need liquidity, it's available for you. Historically, working capital has fixed income. So when you get into a difficult situation, you can use your bonds to raise cash. We had some days where US Treasuries didn't trade. Literally.
But stocks get traded anyways at a price.
But the point I want to make is that, so we came in an environment in March and April where we were finding ourselves essentially fairly strapped on liquidity, not just us, but the rest of the world. And that's when we began to make sure, even before that, we had liquidity to begin with, but we began to make sure that we had liquidity to meet whatever needs we had and obligations going forward. Now, by the way, let's actually ignore the last couple of months because no one really, frankly, has any insights on what is going to happen in the next month or what happened in the last 2 months. But we've actually always had a higher cash balance coming into this. And in the last 5 years, guess what? It did not hurt because you were not getting paid to take risk. And that has been the case in the pension, in the endowment, and frankly, all around the world. And that complacency for lack of returns, for taking higher and higher risk, is frankly what came to roost for a lot of people in March and April when the markets dislocated. So yes, in the short term, I agree with you. And timing the market is a very difficult thing to do. I made the decision to be tactically positioned the way we are, but it's not a decision that's for the long term. It is a decision for making sure that we have the capability to act on good opportunities when we see them. Now, there may not be a lot of other investors around the world that have this kind of positioning, but Warren Buffett has $137 billion of cash. Having said that, we're not Warren Buffett, we're not Berkshire Hathaway, but having the liquidity can be helpful when the opportunities arise. So my focus is not spending time now on what are the risks in the marketplace, because we've shored up to balance those and put ourselves ahead of that game. My focus is, where are those opportunities? So any one of you or anyone else you know that has great opportunities that I should look at, 510-599-4206. Well,
You sound like one of those commercials for mortgage lending. By the way,
mortgages are a tough place to be right now, by the way.
Warren Buffett is an insurance company, so he has to keep a lot of cash. But I don't want to be argumentative. All I'm saying is that at our 6.7 discount rate, if you're keeping half of our assets in non-returning, zero returning money between cash and bonds, and we may have a hard time returning that 6.75%.
Yeah, Regent Makarishan, I completely agree with you. Your viewpoint is absolutely spot on, and your prediction of what would happen if we stay invested like this is perfectly accurate. Having said that, the only reason I'm positioned this way is to put money to work in opportunities, which I think we both agree on wholeheartedly. The only question is, what are those attractive opportunities going to look like?
So maybe we should advertise on television with your rather than to this audience. But any case,
I think it's easier with this audience because
we can't bring you opportunities because we get conflicted out. So we tell other people to bring you. We have a lot of opportunities, but we can't bring it to you. Anyways, that's just my comment.
I take your point. And I think we both agree that this is a high amount of liquidity. On the flip side, I take responsibility for that, and I take full accountability for making that decision without a question. And I could alternatively come to you right now and say, you know what, I have a quarter of that amount, and it's all in the stock market, because that's how the asset allocation is projected at being right now. And then we could be having a discussion around, what if the stock market is down 20% from here? By the way, we were there 2 months ago. So I certainly don't have the wisdom to be able to answer this question, but I certainly have demonstrated with our team that we can be opportunistic when those things arise, and we definitely want to take advantage of those opportunities.
That's fine. That's my last comment, and I'll stop here. Thank you.
Jagdeep, kind of a corollary question around this. The cash is acting obviously as a buffer for us in terms of a downturn. Do we have any significant positioning that would take advantage of a downturn, i.e., in the broad sense, a short position in any way, or hedging that's significantly weighted to negative performance of the equity markets? Or is our large cash position effectively acting as that buffer?
It's the cash position that's acting as a hedge. So in fact, here's something interesting. Absolute return or hedge funds tend to provide you that kind of a hedge during markets like this. I was pleasantly or unpleasantly surprised with how some of our larger positions that we had with hedge funds actually moved in the same direction as the markets. In fact, worse than the direction of the markets because of the attractiveness they felt about taking risk at a time when there weren't any absolute returns available in the world. So there are a number of people that have employed insurance strategies for which they've paid premiums to hedge themselves. I've just had a view that cash is a good hedge to have, and you get paid to hold it at a time up until now. Now with the stimulus, that's zero. Hopefully no negative rates in the United States, but absolutely the cash is the hedge for the downside if the markets go down from where we are right now.
All right, I'm going to go to Regent and then Zettel.
Thanks, Regent Sherman. Jagdeep, I've got a kind of a side question here. Tomorrow in finance, we're going to be voting on amending the retirement plans to allow for hardship distributions and loans for our employees. And I realize, at this point, you probably wouldn't know the the gravity of people taking advantage of that or the need for it and the like. But as our chief investment officer, I thought it'd be important to maybe get your thoughts on the wisdom of something like that. Obviously, you can't fault people's individual circumstances for the need for such distributions and the loans and the like, but I thought I didn't want to miss an opportunity to ask our chief investment officer on something like that, if you care to comment.
Look, I mean, this is obviously a time of hardship, and I think the same sentiment that we've just discussed around how do you sustain yourself. Cash is what you need to sustain yourself through difficult times like this, and we frankly don't know how long that is going to be. But Regent, I'm not quite sure what kind of a comment I can make that would give you a more direct response to your question.
Well, and again, admittedly, it isn't sort of an unfair question in terms of the way it's set up, but I raise it, I guess, for a couple of reasons. One is obviously there's other companies that have already started allowing this to happen under the CARES Act. So if you know any in terms of what the kind of the loan and distribution rates have been. And then secondly, I guess what I'm trying to hedge here is the fact that there's already sort of early indications of solicitations to folks to sort of take advantage of this as some type of a market hedge as opposed to true needs and distributions. And again, I'm not trying to put you in an uncomfortable spot to sort of comment on it, but I would think there would be some wisdom to pass along in a situation like that, and the wisdom of making early distributions and what the impact it is for long-term retirement savings that individuals might have.
So for the retirement savings program, as you're aware, there are options now to take out distributions. One of the things we saw happen at the beginning of the crisis in March was our retirees started to withdraw money from the retirement savings program. They got nervous, and we were seeing almost 13, 14, $15 million going out per day. And on the 20th of March, I hosted a webinar, and we actually ended up having about 3,000 people do this Zoom meeting to hear sort of what wisdom we could provide them. And the message there was sort of stay the course and have a plan. And shortly thereafter, we actually saw a reversal in trend in terms of withdrawals from the retirement savings program. And actually, we track that now on a daily basis. And as of yesterday, the number is about $400 million that has been withdrawn from a base of about $25.5 billion in the retirement savings program. So that's one indicator of what we're seeing is how people are reacting to these markets to tap into their hard-earned or hard savings in order to shore up their sustainability for the next couple of years. There are now these programs by which they can actually make withdrawals, which is, I think, what you're referring to as well. I think if everyone's situation is very different, and depending on what their individual situation is, I'm personally of a view that the only thing that gets you through this right now, the only medicine in a financial sense, is cash and sustainability. And so, however people want to manage that, they should look at all possible sources and tap into that and have control over it to manage their destiny, because we just don't know how long this goes and how it shapes up. And if I haven't answered your question, I apologize, but I'm happy to take it offline.
Great, thank you.
All right, we'll go to Regent Zettel.
So thank you very much, Chair Sherman. And I think you already asked this question, and forgive my naivety of terms, but I'm wondering, Jagdeep, if we do much selling short as a hedge. I know in our own portfolios, oftentimes we will do something like that. What are your thoughts on that?
Yeah, so there are hedge funds that have long short strategies where they go long stocks and they also short stocks as well. And we do have a couple of managers that are long short strategies, so that we do have those types of strategies. But That is, it's part of our overall portfolio where we have different kinds of other defensive investments. In fact, arguably, some of your best hedges to this crisis have been being invested in China, long in China. In addition to that, being long biotech and healthcare, being long Amazon, Facebook, Google, Netflix, Apple. These are not intuitive hedges, by the way, for a global pandemic of the sorts we've been dealing with. In fact, you could make the argument that being short by not having oil and gas has also been a good posture for the last couple of months, and frankly, for the last 6 months or so. So, you know, the positioning of the portfolio in the way I've described to you, we've had a number of these things play out to our benefit. But at the same time, it's very hard to predict that these would be the things that would work out in this pandemic to your benefit. So being diversified as much as possible and balanced and getting pleasantly surprised by these positions is more helpful than trying to look for a perfect hedge. Because the challenge I think we have with hedging is there are a variety of ways to do it. And there are people that have an industry to hedge things for you, for which you pay them to hedge. But unfortunately, they may not work out. Or more importantly, what happens is, as human nature evolves, we tend to get too excited about holding these on for too long because it seems like a cost and a drag until the crisis hits us. And then we don't have the hedge on. So there's a variety of ways these things play out in terms of human behavior. And that's why I fully agree with sort of, I guess, the two bookends of the conversation, which is hold cash as a hedge and find as many opportunities to put your money to work as quickly as possible. All that, of course, you know, I mean, if you take a long-term perspective, it's absolutely the right thing to do is to be fully invested. And at the same time, we are living at a certain time right now where we don't know what the economic reality looks like. I mean, if you take the stock market valuation today, any index globally, even by historical standards, the values of these stock indices suggest that the stock market is highly valued. Forget the pandemic. That's a new thing. Before the pandemic, we would be making the argument, should we de-risk our equity portfolios because of how the values of the equities are? So now, so yes, whilst we have some long-short strategies, I think at this point, what I'm most excited about is looking for where those hedges that might not necessarily be shorts, but might actually be long positions in things that will be benefiting from the new world normal we might be in. Who would have thought that commercial real estate could be a challenging investment at a time like this? I didn't. You know, we normally think of real estate as a good income generating, stable portfolio to have. But it would have been good potentially to be short some of that at a time like this versus intuitively thinking about being long real estate. Hospitality, hotels, airlines, lodging. You know, what the best thing, I recall having this conversation with our real estate team a few years ago when we were looking at data centers, and the conversation was, well, this isn't real estate really. It turns out the best performing real estate investment have been data centers in the last several months. Which interestingly enough is not your traditional real estate investment. So the idea of holding things long and shorting them in a traditional sense is absolutely one kind of strategy. But I think overall, being positioned in the things where the world is going is what I am excited about, where we can put this money to work, leveraging our competitive advantages of being in the University of California with access to healthcare and knowledge and technology in California.
Thank you.
All right, next, Regent Lee.
Thank you very much, Regent Sherman. And one thing I love about Regent Sherman is you can call him at any time and he is in a good mood when the market is up and a really bad mood when the market is down. That's what you want, you know, and something like that. And I also say, I've been on the board for 1.5 years. This is not, of course, my area of expertise, but I have to say to understand what's going on, I have to ask a lot of people in terms of their opinions of our top leadership at UCOP. And I will say, Jagdeep, so many people have so much respect for what you do. And I can tell that this is a 24/7 job for you, and you think about it all the time. And I like your position and the statements you've made about cash. It may be a little bit more conservative than some, but in the situation of what we need to do, I think your whole philosophy on cash right now is something that just resonates with me. So congratulations. My question is actually on a completely different subject, but I wanted to ask it because I think it's important as we move forward. And that is, we've spent a lot of time over the last couple of years, and I congratulate our president for really working hard to get first generation and underrepresented minorities into our university system. And I think it's really important for a lot of people, myself included, that we really focus on trying to also open up our whole system in our investments with people backgrounds. And diversity is super important for a lot of us. And I just wanted to ask what steps you're taking to ensure that, both in terms of our own staff, and I know you've pared it down over the years, which is good. You've kept our costs low, but I'd love to hear just a statement on your actions on diversity, as well as when you work with managers to make sure that they are also doing that. Because I think one thing I've learned as a regent in the last year and a half, going around talking to people, especially in the Black community and in others, they feel shut out of this whole arena. And I just think we need to make an effort to do something about that. So I appreciate hearing that. Thanks.
Thank you for your comments and what you've suggested around diversity, equity, and inclusion is where certainly in the last year and a half to 2 years, we've began turning more of our attention as we have been evolving around how to implement environmental, social, and governance frameworks in our investments portfolio. You've seen us put out our baseline demographic survey last year that does really just describe the state of the union for where we stack up. Overall, we've been lucky enough to get good acknowledgments on that survey from a variety of industry leaders who care deeply as much as you do and others on the committee do on this topic. Having said that, in my own personal markings of that survey, we don't stack up very well. And our numbers may look a little better than the rest of the industry, but they show that for what needs to be done, we are very far from what I would consider success. Now, I know you've asked me, all of you have asked me historically, what does success look like? I think success for all of us around this topic is driven by, in the investments portfolio, good performance. And we've also seen studies that demonstrate that diversity of thought and ideas and minds leads to better performance. And so there is a correlation to good performance with diversity, academically and both practically. So as we now continue this journey to build upon the baseline that we've set and the demographic survey on our markings on diversity, equity, and inclusion, this is an area where we continue to make progress in. So specifically in the last quarter, in our public equities program, we actually introduced a new manager. And as you know, we have a very small roster of managers across the organization. And so adding one to a list of 8 is a big deal for us, but we were very happy that we added an exciting sort of manager in the small cap arena. And so that's our first, that's one of the steps we've taken as we continue to add investments to our portfolio. In fact, what this crisis has also shown us is there's an inequality in the way communities are affected by the current crisis. So I'm hopeful that we can be even doubling up our engagement right now with the investment community to figure out where those opportunities are for us to invest, hopefully at attractive prices, where we can actually use our capital to make a positive contribution around this. But the marker going forward is continuing to add more specifically African-American managers, Latin American managers. I think we've got a good roster of Asian American managers in the stable. and women-led teams and other minority groups. So I would like to see explicit progress around African American, Latin American managers going forward.
Thank you.
We have President Napolitano.
Yeah, I just, Jagdeep, wanted to restate something you said for the committee that I thought might have gone by the wayside, which was that the university's entire investment portfolio is now fossil free. I think that has been a goal for a while, and you've managed to achieve it. It's very consonant with other positions taken by the university, and I just wanted to acknowledge your success there.
Thank you, President.
Next, Chancellor Hoggood.
Thank you. Jagdeep, I know you've stressed the inability to predict, particularly the short term, several times. But let's say that the pandemic aspect of the current environment plays itself out one way or the other over the next 2 years, meaning is largely out of the environment in the next 2 years, either just through burning out or vaccine. In the last committee, there was a significant approval of major capital projects, particularly here at UCSF. What's your crystal ball tell you about the capital markets, and particularly thinking about when to access the debt market for some of these major capital projects that are coming up, in terms of, is it 2022, 2023, 2024? When do you think that's going to optimize itself for us to think about borrowing?
Chancellor, I think the answer is now. It's yesterday, and it's day before yesterday. There is an urgency in my mind to take advantage of shoring up one's balance sheet for whatever the needs might be, and particularly capital projects, working capital requirements, real estate that needs to be built, debt obligations. We actually have so much money that's been injected into the system by the Federal Reserve and the backstop around that. What surprises, we've seen record issuances of corporate debt in the last 2 months that, frankly, for the rates that people can raise money at, for the type of companies, when you have a cruise company that is raising debt at very attractive prices, I have a hard time matching a 2-year time frame to the cruise company. I would think that this is the time to do it right now, because as much as 2 years from a healthcare perspective gives us a great line of sight, and I really appreciate that wisdom, Chancellor and Carrie's and others around, this is the window to look at. By June 30th or September 30th, if businesses are shut down, we could see a lot more economic pain. I'll give you one indicator. Yesterday, I had a call with a company that manages bankruptcy restructurings in the United States. They're one of the larger ones. And they said at any given point in history, they've always maintained a watch list of companies that could potentially go bankrupt. The list was about 20 companies at any given point. Now that list is 120 companies. And they've never seen that. And so you really have a situation that we are uncertain about the level of economic damage that could happen as a result of shutting down the economy this long and how long that proceeds. For companies to be starved of revenues and earnings for 6 months or 9 months or 12 months is a lot more damaging than solving the overall healthcare crisis in a 12-month period. So when capital is available in the markets, which it is right now, and the kind of credit rating we have, my humble advice is to the president and to Paul Jenny and anyone on the committee here, please take the debt that you can get in the markets right now and shore up your balance sheet. I'm happy to loan you money, Chancellor, at a good price. I have cash.
All right. Next, I have Regent.
Adi, are you happy with that?
Regent Markarician.
I was trying to find my cursor, so.
Okay.
No, actually, if you're going to lend it at 1% or negative rate, I mean, that's, I don't know how Chancellor Hauge is going to receive his pension down the road. So you can benefit the hospitals, but not his pension. No, I guess my concern, I go back to what we were talking about, the real estate and this virus and all that stuff. Aside from whether, find a vaccine, and, Chancellor Hauge and the health committee and the governance committee get a lot of briefing as to what's going to happen down the road. But whether we find a virus or, find a vaccine, or don't find it, or find a medicine or something, I think fundamentally people's thinking has changed. I think look at you and your entire staff. For 3 months or 2 months, you've been operating from your house. I just saw your letter that you had sent a couple of days ago that, everybody's having such a wonderful time, and you're doing all of your work. And as somebody said earlier, 24/7 at home. You walk in, you walk out, and, walk into your office, only 10 steps. So the need for office buildings, the need for, large convention hotels. Look at how we are operating this meeting. I mean, every time we used to go to UCSF, it would cost, Janet is on this meeting. To me, somebody had told me that it cost, just for security, was a couple $100,000. Now, let alone the travel, the hotels, everybody was staying, all the shuttles, the food, the wasted food, and all that stuff. So fundamentally, we have, I think, everybody's lives are going to change. I mean, I don't think anybody's going to be going to an office and have these pigeonholes, or maybe office buildings are going to restructure. They just have some conference rooms and a couple of desks, and everybody else will work from their houses. I don't know. But that's the thing that we should be thinking about. If you're talking about real estate and investing in real estate, I know Gloria, who's been with you for a long time, she's either resigned or she's retiring, and other people are coming. But we really have to fundamentally think whether you're investing in something, not the 2 years or, cash on stocks and all that stuff, but where is it that we should be investing that the next 10 years, 20 years, or 5 years, 7 years, that we get the highest return, because of the shock that people have gone through that has never happened to us. I mean, when you see malls are going bankrupt one after the other because, no retailers, Neiman Marcus is going bankrupt, JCPenney's after 135 years is going bankrupt, J. Crew is going bankrupt, and all that stuff. Fundamentally, where are we going? And I think that's something that the investment side for your people, and with the investment committee, Richard, and asset allocations and all that stuff, whether it's going to be China, it's going to be more in other countries or whatever. Those are, I think, the most important things that we should be focusing on at this point in time for the future long-term survival and funding rates of the pension.
I absolutely agree. And, that is actually the exciting part about how we're positioned and where we can go. There is a mindset in institutional investing that you take a benchmark and you try and hug the benchmark. And if the benchmark is 25% in retail, you put 25% in retail and off you go. And no one is going to fault you if you performed like the benchmark or did slightly better than the benchmark. What I'm talking about, and the way we're positioned, is it's off benchmark. Because the world's benchmark has just changed. And I think we need to sit back and think about what's the new benchmark. And if data centers are better than hotels, then we should be thinking, and they may not even be in the benchmark right now to an extent where it matters. We should be overweight the sectors that we think the future is heading for. And so that's one part of it. On the flip side, I will tell you, interestingly enough, many a times cash is an itch in your pockets historically coming into this. I'm kind of glad I didn't put all that cash to work in a variety of things that were sold to me in the last 5 years, because now I'd be sitting on reworking my portfolios versus thinking about engineering them for the future. So There's a lot of things where people, private credit was attractive. It was juicy to get a higher yield versus fixed income. So you could pile into a whole bunch of that stuff. Frankly, oil and gas was low, so you could put your money into oil and gas. Real estate was not cheap to begin with. If you didn't have any other place to go, just put it in the stock market because it's going to keep rising for you. So at some level, avoiding the temptations based on fundamentals that you don't believe make sense has put us in a better, stronger position, feeling more comfortable to figure out where the future is. Now, I don't know where that future is, but I think digital, anything that is, electronic in nature versus sort of physical in nature, the types of things around healthcare and biotech and new delivery systems that we need to think about. I mean, and this is the beauty of America. I mean, America is it is the most creative engine on the planet. That coupled with the most flexible monetary system that we have seen fueled $10 trillion or so into the economy. I think we're an unparalleled force on planet Earth. And anybody can do whatever it likes to do to America, but that combination makes us successful. And our job as investors is to be aligned, because you don't want to bet against America over the next 10 to 20 to 30 to 50 years. But having the capital and being positioned to take advantage of it is what I'm most excited about. Now, these are the 800-pound gorilla questions in the room, but we'll figure it out. We went from doing some interesting things to hopefully now doing even more interesting things over the next 5 years that aren't in a benchmark, but they're the new reality.
Well, and that's the most important responsibility for this committee, I think, asset allocations, and then within those asset allocations, picking the right future potentials for us, because otherwise, realistically, I mean, the cash is not going to buy you anything unless you put it someplace, and that's where you're going to put it. So we have to be thinking about, what's the future going to look like, absent this virus or with this virus?
Well, I think the virus just was a catalyst for a lot of trends that we were already seeing in the world. Retail was on its way down. I mean, there were a number of things that were challenged. Car rental companies were challenged to begin with. The virus became an injection to catalyze at very high speed the demise of a number of traditional industries that were on the edge anyways. And I think what we're seeing is this acceleration the good news is, we were beating down on healthcare and bio companies and pharmaceutical companies with all kinds of issues. Now we need them to actually get us into a new future. So I think, look, that's why this job is to invest and not to hug a benchmark. And investing means taking risk and figuring out where those opportunities are. So if it wasn't for that, Hadi, it would be really easy. I could put all the money in the stock market tomorrow. We'd be sitting here. We were exactly at our asset allocation. Every quarter I'd come and tell you we were down 5%, we were up 5%, we were here 3%, and that would be it. That wouldn't make this for an exciting conversation. So I value the back and forth, but I need your guidance as we go through this time period, because I think this is where the support that you've given me getting here is even doubly more important going forward to figure out ways to invest the capital. And with Regent Sherman's guidance, I very much appreciate, and the support of all of you, where we can take this.
So along those lines, do you see any restrictive covenants that we have that is not letting you do your opportunistic things that we can remove so that you can take advantage of this situation, or any governance issue?
None whatsoever. Coming into this,
I'll give you one example, because you say none whatsoever. For instance, you're prohibited from investing in UC's certain projects. You can't put our own pension, let's say, in student housing that we know for sure is going to make money.
Right. Yeah. So I answered that question from the standpoint of the governance and the way we operate with each other between the office and the committee. You've given us incredible flexibility to be able to execute on the decisions we want to make and how we want to be positioned. Now, on specific projects like UC projects, whether it's student housing or faculty housing, we've talked in the past about creating a real estate management company to actually house those types of projects and make sure that there aren't the conflicts of interest and that we don't come into accounting limitations of owning, related party entities or things like that, based on the limitations that are set by the funds we're managing, whether it's for the pension or the endowment. But frankly, those are all workable solutions when we figure out what projects are attractive. They haven't been an intense focus of ours so far, because some of our chancellors have been very active in doing that with their own balance sheet. But as we think about that into the future, particularly real estate, I think the real estate management company and figuring out how to do that is very achievable. That's the only one we haven't really tested out yet.
Okay, because earlier on you said to Chancellor Howgood to come in and borrow from you, that's prohibited. So we can remove those. Yeah, things like that.
Okay.
You're thinking about those certain.
If I come across any limitation as we're thinking about opportunities, you're pretty sure I will come to you right away.
All right, fair enough.
And knowing Regent Sherman, I'll get an answer in 1 minute.
All right, last on the list, it looks like I have Regent Weddle.
Hi, everyone. I'm not on the committee, but thank you so much for letting me be here. And I really enjoyed being a fly on the wall for the conversation. I appreciated Regent Lieb's comment about equity and also the response. I just wanted to make a suggestion that perhaps it would be helpful to come up with measurable equity goals in relation to our investments. That way this committee could have a better idea of how close we're getting to success, to use the terminology that was used earlier.
Yeah, so the measurable goal for us is increasing the number of investments we have with African American and Latin American managers, and good, high-performing investments like we expect from all of our other investments on equal grounds. And that, as we grow that pool of assets, we can continue to report on the success around that, which is obviously driven more by how much we've deployed. And obviously we can share with you what the short-term performance is, but performance is clearly the goal, not just for any one thing we do. By the way, the same applies to oil and gas. We don't look at oil and gas as a goal that has to be accomplished by a certain amount to reduce a certain amount of investment. We look at it as a financial risk or a financial opportunity. And that's the equal measure that we use for every investment we make across the organization. We can certainly highlight what we're doing in different areas, like in diverse managers or other areas, but that would be the way we would identify the measurement for all of you.
That's really helpful. And maybe I should have phrased it this way. I also think time frames in terms of, and I won't be on this board, but what this board can expect in terms of reaching those goals in a particular frame of time. I'd also be interested in hearing more about that. It doesn't have to be right now, but maybe at a different meeting.
Yeah, I think we've talked before, Jagdeep, at previous meetings about that you would report, I think, semi-annually on our deployment with diverse managers and how we're progressing along that path. So I don't remember what we earmarked as the next time you'd give us a report, but I think it was maybe 2 meetings ago. You had the diversity report, so probably update that, maybe shoot for our next meeting, and then let's do it semi-annually thereafter.
Sounds good.
Great. I have Regent Park.
Thanks, Chair Sherman. I just wanted to express my thanks, though. I know that the world has changed. There's a lot to be concerned about. But of course, we can't sort of put this by the wayside until things are normal again. And so I just wanted to say, there's an awful lot of materials that are prepared for these meetings. I mean, I think this one totaled like 169 pages in terms of, different slide decks and different write-ups. So given that context, there's like so much, there's so much that is being highlighted. Just to be able to highlight, the achievements in the divestment, but achievements in diversity. And where we're struggling, we understand, but just to continually kind of to address the issue to recommit ourselves. I think those are important things. And frankly, I think, they're really important in these troubling times that we can maintain this really strong commitment to our values. So look forward to seeing, a robust next report as you deal with all of these other really pressing matters.
Thank you. And all of these issues are equally important. In fact, after we gave you, I think it was in December, we sent out the demographic survey, which you could consider a comprehensive update at that point in time. It was a bit surprising to us as well that those that have been significantly passionate about this subject in the asset management industry actually used our report as a benchmark to reach out to presidents of many of the Ivy League schools in the country. In fact, Reverend Al Sharpton specifically took our report as a leading example of efforts around a demographic baseline around diversity, equity, and inclusion, and send that as a formal letter to the presidents of quite a variety of Ivy League universities in the country. What that tells me is that certainly we're being public and transparent about publishing our information. That was as late as December of last year. I think I shared with the committee as soon as I was aware of that information between the meetings, the report, and then of course we had the global pandemic. So here we are, and this is clearly a very important topic. And but at this point in time, due to the nature of the circumstances, you can appreciate that I wanted to keep this meeting focused on the issues around sustainability of the financial institution that we all are so concerned about. And I didn't want to dilute any other information, but all of that material exists and we've shared it with you. And as you see from me, from time to time, I even send you emails in between meetings quite frequently. So I don't necessarily need to wait to give you information when we have it in real time. And I will continue to that practice. But the goal here at this meeting was to make sure that we kept this topic front and center and continue to update you on other things outside of the topic. As you notice, I didn't even talk about fossil fuels, even though that was a very significant milestone. But I did not want, and I think we're probably the first university in the country and the pension plan to take a position like we did. And despite that milestone, at other times, it would have been an important conversation to have today. But my focus has been on making sure the University of California focuses on its financial sustainability and have a good picture of doing that based on how we're positioned. Thank you.
I appreciate those comments and the context, but based on what you said initially, it just sounds like there's so much opportunity for us to continue to lead the way on fossil fuels, on diversity, on these other topics that are really part of our core values. So I appreciate you want to focus, but I would like to say, including these things in our meetings, I think does signal that we're not putting these on the back burner despite these just unprecedented times. But thank you for your comments, Jagdeep.
Now we'll go to Regent Simmons.
So I appreciate the work that's been done. I've been part of a lot of conversations, and thank you to my colleagues as well who have brought this up. Seeing as this is probably one of my last investment committee meetings, wanted to thank you and your team for the work that has been done thus far, but to echo the comment of we would love to hear it more often. And I would almost say anytime you present any of the successes, that it would be great to see it even more often than semi-annually, just as a part of everyday conversation, both this and the sustainability initiatives and the divestment of fossil fuels and the performance therein. And then I would also offer that because of the pandemic, this is why this is as important, because these populations will be disproportionately affected, that it's important to invest in these communities in meaningful ways. And so again, thank you for the work that's been done. I don't think the investments committee even knows a lot of the work that you've been doing behind the scenes, both on the survey. I heard you mention the hiring a little bit earlier, and then several of the meetings that I know that you've had, as well as your diversity committee, advisory committee. So tell us more. We want to hear more. We want to hear the good work that you're doing, and we want to hear it. Well, they will want to hear it in all the future meetings. So thank you for your work on it, and I look forward to continuing to partner with you on it.
And thank you both. Thank you all for your comments around this. In fact, Regents Park and Simmons, as you know, we actually had a meeting with you privately in between the last meeting and this meeting, specifically to update each of you on the efforts that we've been focused on around this. So our work does not start and end at a investments committee meeting. It is a day-to-day practice for us, and it happens offline because those stories happen in real time. And what we've seen is a real-time dislocation around how this pandemic affects communities of color. In fact, I have a preference to say after we do versus before we do things, but I will tell you, I am starting during this financial crisis of sorts. I hosted a series of conversations with university leaders all the way from Carrie to Janet to Pradeep, John Perez, and others around what the university is doing and thinking about in these times. And we just concluded those series yesterday. In June, we'll be starting a series of Q&As with me on Zoom every other week or so, specifically focused around diversity, equity, and inclusion. In fact, I've lined up our first 4 speakers for those series. I'm sharing that with you now because it's before the fact, but my preference is always to talk about the things that we've done. And so this is the kind of thing we're focused on right now, because exactly what you've said is very true, that there has just been an unequal impact, particularly to colored communities and the diverse communities in the country. So this is a time for us to focus on what more we can do now in terms of helping out to create a sustainable future for those types of communities and organizations.
All right, we have Regent Bhavani.
Thank you, Chair Sherman. Jagdeep, thank you very much. And of course, thank you for thinking about all those who are especially vulnerable in this pandemic, as we know from some research done by UCSF, that, for example, in the Mission District in San Francisco, 95% of population they sampled that is Latinx, cannot work at home, has to go out to work. And that, of course, increases people's risks. So many thanks for thinking about that as you take care of the university. My question is slightly different. You've been talking about borrowing and refinancing in one way or another. Do you know if any institutions of higher education in the US have used that as a strategy to tackle the emergency that we are all in, and that Chancellor Horgood says we could imagine perhaps that COVID would disappear in 2 or 3 years? Do you know of any institutions of higher education that have done that?
There are a couple of higher education institutions that have raised debt in the market, and we raise debt all the time ourselves as part of our debt strategy. So if we have the capacity to raise debt and it fits with the strategy, it's a very normal thing to do. And at times like this, even with the backdrop of the current world we live in, rates seem to be very attractive to raise debt at if you take a long-term perspective. So some institutions have taken advantage of it, but this is such a, it depends on, what your credit ratings are and what your cash needs are and what type of debt you're raising. But we've definitely seen headlines in the last 3 months of institutions raising money. I think Harvard comes to mind as one of those institutions that has gone out and raised money in the debt markets.
Could that be a strategy for the UC, or is that totally out of bounds?
I mean, finance and capital strategies, Paul Jenny and the president have certainly been all having these discussions. And I think raising debt capital and continuing to raise debt capital is an important strategy to consider as part of their overall financial strategy. Yes, absolutely.
Cheers, thanks.
Okay, Jagdeep, just one kind of like follow-up question. Have you had any reporting of trends on the retirement savings plans? Like, did the employees make any major moves in their allocations, those that have the ability to self-direct their retirement savings plan?
The data we see is the monies that they've withdrawn, or the inflows or outflows into the retirement savings plan. And what we did see is that in the early part of March and actually through now, about $400 million, and about half of it from the target date funds and the other half from other funds have gone out, have been withdrawn by the retirees, or the participants in the savings plan. So we've seen that trend, and up through March 20th, that was accelerated from March 20th, probably till about a week or two ago, that was fairly muted. But then going forward in the last 2 weeks, we've seen more withdrawals. A trend I have seen, which I think is interesting, is that retail investors have been a big part of supporting the rising equity markets. The levels at which retail investors sitting at home, potentially not playing video games, but working in the stock market, and putting money into stocks, whether it's Gilead or Disney or whichever other company they find interesting, has led to sort of unprecedented levels of activity from the retail investor in the last 2.5 months. That's interesting to watch, more so than even in 2008. But for us, the data that we can track is what I've shared with you. We don't know exactly what they're doing in their brokerage accounts, where we have about $1.6 billion, because that's directly with Fidelity. But our goal is to make sure that we can communicate with them actively, and make sure that they at least understand that, you know, there are options for them, and staying calm in a target date fund for the long term is the better option for them than trying to be volatile.
Yeah, and for those that may be experiencing financial hardship, do they have the ability to borrow from their retirement savings or have any kind of hardship withdrawals? Is that a need that may not be in your wheelhouse, but
no, it is. I mean, there is legislation now, and there is the ability to, I think, withdraw up to $100,000 from your retirement savings plan. I believe that's on consideration for the committee, the Finance and Capital Strategies Committee, but it's something that we can also make available to our own participants. And that's something that's for consideration by the regions as well. Absolutely.
Okay. Hadi, did you want to make a comment there?
I was just going to say that item is coming tomorrow for approving up to $100,000 withdrawal. That's one comment that I wanted to make. And the second is that I know this is probably the last time we will have Gloria on your staff. And usually you bring all your staff. I don't know if you're listening to this, but I just want to thank Gloria that was heading the real estate. And she's been, I don't know, driving, flying, whatever, for 10 years from Southern California to Oakland. And she's retired.
Yeah.
I want to say thank you, Gloria.
I second that on behalf of the whole committee. And in closing, special thanks to Jagdeep and the team. It's not easy navigating these waters with the volatility that we've experienced since, late February. It's you guys have done a remarkable job holding the ship together, and the performance, although negative in some ways, we've beaten the benchmarks, and that's a testament to your team's implementation of the asset allocation. So I don't know whether you have any parting words for everybody till our next meeting.
Before you do that, I second what Richard said, but I don't know if I should get into your family situation. But Jagdeep's wife is one of the front fighters of the virus. She works she's a physician at the emergency, and she goes back and forth to Boston. I don't know. Jagdeep never sleeps. So not only he keeps the family together, but also he gives the investments returns.
Yeah.
Thank you from me too.
Yeah. Thank you all. And maybe I have a parting question to Regent Makarishan, more than a parting thought. Where are you seeing the opportunities? And if I could put all the cash to work, or some portion of it to work today, where would you recommend I do that?
Well, we're online and we're in the open, so I wouldn't.
No, but generally in terms of sectors, like what are you seeing? As
I think he'd recommend Marco Region Properties. There'll be a 1-800 number posted. No, I'm just kidding.
No,
The
but
reason I asked the question, I actually asked the question more from an asset allocation perspective, not from a individual transactional perspective, because from an asset allocation perspective, in the pension and the endowment, we're overweight cash. That really is a board CIO conversation. So in that context, holding about 20% of cash would be considered a large asset allocation position. That's the question I'm asking. If I could change that, and what would you be more comfortable with in terms of asset allocation? That's really my question to you versus a specific opportunity.
well, the reason I said that is that it's not a 1 minute response, but what I was suggesting is that you and your team, and maybe whoever wants to join, to have a separate meeting and really hash through that kind of stuff. I mean, what do we think? What do we think the future is going to look like? You mentioned that retail was going down, and this thing, pushed it right off the cliff. But then, on the other hand, think about Airbnb was competing with hotels, and it was going off the roof, and now it's going the other way around. So Airbnb wasn't going down, Uber wasn't going down, Lyft wasn't going down. They're all speeding up, and now things have changed. So those are the type of issues that I think we should be thinking about. But if just like you said, you have divested from oil and gas and that kind of stuff. But what is the future? Where is the future going to go? Should you buy real assets in, hydroelectricity someplace in Canada or other parts of the world? That those type of stuff is not going to go away, and it's going to have a huge return. And it's not a 1 minute discussion, but it's what I was suggesting is that maybe Richard, yourself, a few people from your office, a few people on this board, and a few other of the consultants, just like the one that you had in San Diego, get together in San Diego, where you had a number of these funds to just sit there and talk about all these things. Yes, this makes sense. No, that doesn't make sense. To me, all these large hotels in major cities, I think that's going to be passé. Are they going to, let's say, the hotel that I used to stay on in San Francisco or any of those little elevators, are they going to take out the whole structure of the building and change those? Because I don't think for the foreseeable future or for even future, things are not going to be the same in certain ways. So where are we going to spend the dollars? Should we give it to something that the trends are going to change down the road? I mean, Michael is on this call, so Regent Cohen is on this call. He can tell us where CalPERS is hiding the money and how much they are investing in what areas. We can talk to Stanford. We can talk to MIT. Not that they have a great track record. You have a better track record than them, but I think the world has changed. I really do think the whole world has changed. All of those, the investments, the way that we used to think about them, I don't think they're going to happen. I mean, Richard is a great expert on this thing. I know this thing pushed the movie theater out, but Netflix was pushing them out anyways. Now, would there be any movie theaters? What are they going to do with them? Some investor, some fund or some developer is going to buy all the movie theaters and build residential of some sort. I don't know. We got to think about where we should be spending the money, not for the next 2 years, but the next 15 or 20 years.
If I could just add one comment, because Jagdeep, you did mention this earlier, and I think when you talk about, as Regent Markarishian has said, we're at a new normal. It's some things, like the 08, 09 crisis, some things changed and came back, others never came back. And in this case, I would say commercial real estate, to me, seems like a very risky investment at this point, because there was so much build up over time. And I think people are now realizing that not is for the short term. For the long term, there will be less need for as much office space. Companies will still have offices, but they might be much smaller. They might not be as necessary. They might share offices. There just seems to me like it's going to be a long-term trend, not a short-term trend on a lot of these things. But I feel good that you've been thinking about this. When you were talking earlier, I felt like you had addressed a lot of these concerns and a lot of these, you're thinking these things through. And so, you know, I understand that, but it's going to be a long time before some of these things come back. And you mentioned movie theaters. I have a friend of mine that owned movie theaters, and I mean, he had to lay everybody off, and I don't think he'll ever come back, you know, so on that. So anyway, just my thoughts.
Thank you. So, Regent Sherman, really my parting thought is that, you know, we can certainly look at the world in a 1 or 2 month context, but if I just acknowledge wholeheartedly what Regents Makarishan and Lieb have just said, what we are seeing today is a structural shift. The world seems like it's changing in the way that we're not recognizing things that happened, you know, a short while ago. So these structural changes require us to rethink the best opportunities to put our money to work in. How we do in a quarter, how we do in a year, how we do in 2 years or 3 years, that's not the judgment for this committee and us. I mean, what matters is how we do over a long time period. And I can 24/7, 26/7, I can sleep well at night knowing something. We are positioned to invest in the opportunities of the future. And that's where, as you've said, Regent Makarishan, I want to thank the entire team of the office, because we're not now spending our times focusing on reworking portfolios. We're focusing our time on where are the next opportunities. And this meeting for me marks that transition point today, where we've told you how we were, where we're at. But the most important thing is where we go from here. And that's what my team and I come back to the UC Investments with. Less is more, team up, concentrate, risk rules, what makes the UC, perfect alignment, and most importantly at the end, centennial performance. Okay. That's who we are, and that's what we're here to do for you. So thank you for the privilege and the opportunity. Right. I think the committee just started at 2:30, so we're done.
Okay.
One comment, can you hear me?
Sure, go ahead.
Yeah, of course. Hi, Rachel.
I've been strangely silent. What has been an interesting afternoon. Let me tell you what we are doing in real estate that I haven't heard anybody talk about. We're going in a major way into the land lease business, which is simply, particularly when you look at properties, whether they're hotels or office buildings, they're over leveraged, and you basically buy the land out from underneath them and lease them back to them over usually a longer period of time, 25 years, even 100 years. There's a market. There's a market for that, and the returns are good. And when you know what you're doing, you're pretty safe.
Thank you. I'm going to reach out to a few of you offline and continue this conversation.
Great.
Thank you all.
All right. Thanks, Jagdeep, and thanks to your team. Please convey our gratitude.
They're watching. Thank you.
All right.
Yes.
Take care.
Thanks, everyone.
Bye-bye.
Okay, just a reminder that the Special Committee on Basic Needs will convene at 4:30.
Okay.
Thanks, Anne. Bye.
Thanks, Anne.